In this introductory lecture, we will discuss the important social consequences of accounting numbers and the problems that make it difficult for accounting to measure economic reality accurately. If you will recall, accounting is referred to as an art. This is because accounting as an art requires the use of skills and techniques to present financial information by following and implementing generally accepted accounting principles. Accounting is a highly analytical discipline which requires very precise answers that are either correct or incorrect. To take a simple example, assuming two similar companies that are valuing their inventory and cost of goods sold using different accounting methods. Company A selects weighted average, while Company B selects first in first out, giving totally different but equally correct answers. So going back to our discussion, the accounting numbers and the related financial information that we construct and present in the form of financial statement have important social consequences. A classic example of the social consequences of accounting numbers is how much tax is paid. The amount of tax that a company pays will determine how much money that the government will have at its disposal to spend for public welfare and services. Accounting numbers can also be used to evaluate the performance of management, which can affect salaries and wages, and even in deciding who will keep or lose their jobs. Accounting numbers can also affect the dividend paying decisions, whether to distribute dividends, even when the company's cost of capital can also be affected by accounting numbers. Before we discuss our next topic in this segment, stop for a moment and try to think of an important social consequence as a result of the accounting numbers. After learning the important social consequences of accounting numbers, our next question is, why is it that we cannot always measure economic reality accurately? And the answer to this question is that it is very difficult to measure economic reality accurately because of the different perceptions that exist of economic reality. In determining the value of an asset, as an example, a company may decide to choose among different values such as entry value, exit value, historical cost, or other methods of valuation. With the availability of choice among different types of values may result in different people having different perceptions on how an asset is going to be valued. Although there are accounting rules and procedures that we can use to measure the economic performance and condition of a business, accounting can have challenging measurement problems that make it difficult for a company to determine its economic performance and conditions accurately. There are three factors that contribute to accounting's measurement problems. First, it is difficult to determine the exact criteria for measuring economic performance and condition. Second, accounting uses money as its fundamental unit of measure, and that money's value tends to change over time. And finally, accounting policymakers have to consider the fact that business managers have motivations to distort economic reality rather than reflect it accurately. In summary, the choice among different types of values as well as the problems and issues that relates to the measurement of these values falls within the domain of accounting theory. In the next video, we will define accounting theory and interpret this definition to understand the topics that are included in the study of accounting.